Deutsche Bank's shares falling as investors remain jittery over the health of Europe's lenders. The cost of insuring against Deutsche Bank's credit default soared to a 4-year high, a sign of rising speculation it might go back on its payments. Now, shares of Germany's biggest bank tumbled as much as 15% today, still deeply in the red currently, and they've lost more than 20% so far this month. Deutsche Bank's credit default swaps, a form of insurance for bondholders, shot up above 200 basis points. That is the most since 2019. Analysts point out that Deutsche Bank has been in the spotlight, similar to how Credit Suisse had been. Like the Swiss lender, Deutsche Bank has also gone through various restructuring exercises. The German bank's leadership has changed as well as it tries to return to a solid footing. It has reported 10 straight quarters of profit after completing a multi-billion euro restructure that began in 2019. But in the current climate, it takes more to convince investors. Some of its bonds were also sold off. Its 7.5% additional Tier 1 dollar bonds fell nearly 3 cents, pushing the yield up to 24%. These bonds have been under pressure since Credit Suisse was forced to write down $17 billion of its 81s to zero as part of a government broker deal. Well, Deutsche Bank leading the declines among its European peers. Fellow German lender Commerzbank down more than 7%. Credit Suisse and UBS, they're also tumbling. And Standard Chartered CEO weighed in on the write-down of Credit Suisse's additional Tier 1 bonds. He said it caused deep ramifications on global bank regulations.
I think that had very profound implications for the regulation of banks and for the way that banks manage themselves.
As part of the deal for UBS to take over its smaller rival, the Swiss regulator determined that Credit Suisse AT1 bonds would be wiped out. The decision stunned global credit markets and angered many holders. Experts say the move is expected to have a knock-on effect on the global bond market. Enraged bondholders have pledged to sue the Swiss government and regulators over the matter. Now, UBS is trying to stem a talent exodus in Asia after the takeover of its former Swiss rival. It has reportedly promised retention packages to Credit Suisse wealth management staff in Asia. According to media reports, UBS Group AG Wealth boss Iqbal Khan made the comments at a town hall in Hong Kong. Mr. Khan also focused on stabilizing Credit Suisse Asia team and boosting confidence. Experts say the move signals UBS's concerns that rivals could use the current situation to poach valuable personnel and clients before the takeover is completed this year. The need to retain talent in Asia is especially acute. According to Bloomberg, at least a dozen private bankers at senior positions have left Credit Suisse in Singapore and Hong Kong since September or are planning to leave. Some of those who left handed at least $1 billion in client assets. They are likely to take at least a quarter of the funds they managed to their new employers. Credit Suisse employed more than 50,000 people at the end of 2022. It was already in the middle of a wide-ranging job-cutting drive with 4,000 positions slashed so far this year. But the takeover is expected to result in many of Credit Suisse's 17,000 investment bankers losing their jobs as the UBS winds down most of the unit. While UBS employs 74,000 staff globally, it will also reportedly look to remove overlapping Credit Suisse roles in Switzerland, close branches, and reduce staff in administrative positions.